Selling a business for $12 million sounds like a dream, but the IRS is one of the biggest beneficiaries if you don't plan correctly. Hi, I am Michael Fry. I'm the founder of RWC for Life. I have been helping people navigate retirement planning for over 35 years. So in this video, we're going to discuss some of the issues that the Whitmores are going to have over their lifetime of retirement. So retiring at age 48 and 51, they're going to have a 40+ year retirement time frame that they need to plan for to make sure that they don't run out of money and don't pay too much in income taxes. So in this video, what we're going to do is address what problems they actually have when it comes to income taxes and their planning. So let's jump right into it. So the Whitmores, as you remember from our first video, Mrs. Whitmore, Jennifer, is 48 years old. David is 51. They both have a long life expectancy ahead of them. In fact, in this plan, I have the last person passing away at age 93. So we're well over 40 years of planning for the Whitmores. Here's what their current situation looks like. Their balance sheet is they have a net worth right now of about $14 million. And out of that $14 million, they have $600,000 mortgage. They own a home right now worth about $945,000. They have invested from the sale of their business about $13.5 million, and they have about $150,000 in their bank. So what we want to do is focus on with the Whitmores is what does their tax issue look like for them over the next 40 years? Because you can see if we look down here in this box right here, this is a tax allocation summary. And you can see out of their portfolio, about 12 million of it is sitting in taxable investments. There is 780,000 sitting in tax deferred assets. This would be money that was in their 401k that they are rolling over into their own IRA. And then they did have money coming from their Roth 401k that they moved into their Roth IRA of about $670,000, which will grow tax-free and come out tax-free. So the issue that they have is over their lifetime, they're going to pay the state of Illinois and the federal government a lot of money in income taxes. And what they're looking for is, are there any solutions to help them reduce legally how much they're paying in taxes? So let me just actually show you some of their problems, okay? So the first thing I want to show you is that over their, sorry about all the screen jumping there, but over their lifetime, from now until age 93, they're going to end up spending almost $29 million. Their retirement, they're going to spend $28,750,000 in retirement spending over the next 40+ years. Now, part of that is going to be buying their property, which is showing right here. If you recall in my first video, in a couple years, they want to spend about $1 million or so to buy a home in Colorado. That's what that big spike is. But you can see this line right here, this baby blue line right here. That line right there is representing how much they're paying in taxes. And you can see it's almost the thickest line of all of their expenses throughout their lifetime. So that is what we're going to try to reduce. So out of the $28 million, just in federal taxes alone, they are going to pay $5.7 million in federal income taxes. Now, there's probably many of you watching this video right now saying, I don't have $12, $13, $14 million, so I'm not going to pay $5.7 million. It's all relative. It's all relative. So what we're doing here in this example is showing a younger couple that came into a windfall of money from selling their business and how they're going to plan over time. But we also work with many people that have $500,000, $1 million, $2 million, $3 million, and they're looking to retire, say at 60, 65 years old, and they want to know how can they put together a plan that's tax efficient, but also have that money last their lifetime. And the strategies that we're going to use work with somebody who has $1 million, or in this example, $14 million, okay? But $5.7 million going to the federal government over their lifetime to age 93, just in federal taxes. So what does that look like? Well, it's coming out on an annual basis. So this is showing a tax projection or estimate on a 1040 mock-up that we have for them. And all their income at this point now is coming from their investments. You can see they have ordinary dividends, they have taxable interest, and they have some capital gains. This is year one of their plan. And there's been no planning done. They just put the money into some accounts, and this is what it looks like. In our future videos, we're going to show you what it can look like if you do some proper planning. So they had an income of $359,000, and they paid the federal government $39,000. They paid the state of Illinois about $12,000 or $13,000 on top of that. And you can see as I click off each year, this is now showing the next year. There's their income, $390,000. There's how much they paid the federal government. The third year, 2027, or 2 years from now, is a little misleading because they took a big chunk out, which disrupted some of their capital gains here. You can see they have more gains out because they did a distribution to pay for the Colorado property. And this year they paid the federal government $68,000. And then I'll jump right past that. You can see it dropped down a little bit. And the reason it dropped down is because the capital gains went back to a more normal range. But over time, they're paying $5.7 million to the federal government. Let's look at this and what it looks like from a cash flow standpoint to them on an annual basis. So this is year one. This is this year and what their cash flow looks like. Now, I'm going to offset one thing really quick. They have a little bit of income coming in right here of $30,000. And that's directly going to this goal right here of education, which is $30,000. And that's because they had a 529 plan set up. That 529 went and paid for that school. So that's a wash. But they do have other expenses. So their living expenses or retirement expenses are about $234,000, which is including their living expense, their housing expense, and their health care. Then they have their goal of $53,000, which part of it is an education goal, and the other part is charitable giving goal. So they're giving about $2,000 a month to their local church. And so that is an important part of this planning because we might be able to use that later to help reduce some of their income taxes. And then their tax payment, you can see, is $52,000, $39,000 to the federal government, and about $13,000 to the state of Illinois. And every year that these numbers will fluctuate. So when we're doing planning with somebody, we're able to go through this and really get a good grip on how much they're paying in taxes, what their expenses are, and then what we can do to reduce those expenses or taxes for them through some money, through proper planning, and then we're using a Monte Carlo simulator to make sure their investments are not going to run out of money and all that fun stuff like that. So let's just get into where do we go next? Well, where we go next is that we realize the Whitmores have a problem. Their problem is they have a large tax bill over their lifetime. And what we want to do is, after some planning, is to see how can we reduce that tax bill for them. So we're going to do that in our next video. Our next video is going to be about tax smart retirement planning and turning strategies into savings. And what are some of the things that we could introduce to the Whitmores to help them reduce their taxes? Well, possibly a Roth conversion. We are going to look at that and see if that helps them out. The beautiful thing is we'll be able to put each one of these into the software and see, did it help them or not help them? Did it help them or did it hurt them? And we'll be able to make our planning decisions based on how our software is walking us through each step. We're going to look at a donor advised fund. A donor advised fund is for charitable giving. And we're going to see, can that help eliminate some taxes for them and reduce their tax burden? Life insurance. Life insurance can be used as a tax-free transfer tool or a tax-free place to hold funds that can grow tax-free and possibly come out tax favored later if used properly, or if it's properly set up with the beneficiaries, it could pass on to your estate income tax free. So that could be a way to shelter some of the income tax burden that they're going to have. The other one that we're going to talk about is direct indexing and some tax favored investing, some maybe tax-free investing. But direct indexing is an important tool that can help the Whitmores, because as their investments are growing, there's losses inside those investments at the same time. And with direct indexing, we're able to take their investments and do some tax harvesting with their actual portfolio. And we're gonna talk a little bit about how that would help them on their planning. So with that said, that is the end of this video. We're going to have our next video right after this called the Tax Smart Retirement Plan and Turning Strategies into Savings. So I hope you enjoyed what you've seen here. Please like, share, and follow. Thank you so much.